Okay, and good morning again, everyone. Again, this is Doug Campbell with Right Way Options. I run the Right Way Options service through the Hit and Run Candlesticks website. If you've never been to Hit and Run Candlesticks, I highly recommend you take a look at it. It's just www.hitrun.candlesticks.com. There's tons and tons of great information there, free information. And also, I wanted to let you know that you can also access us by our free smartphone app. If you're looking for some great information, we put out morning information every day. Rick puts out trade picks and all kinds of stuff. You can access that free on the phone app. Just go to your app store and search for, just a second, I'm going to type it in. Search for HRC Trading, and you can download our app and have access to us from there. And you don't have to be a member. Up in the upper left-hand corner, there's a little, if you aren't familiar with phone apps, there's a little icon up there with three straight lines. That's actually the menu. If you touch that, it will open up a menu, a side menu, so that you can go in and access videos and all kinds of content from the phone app. So feel free to download that at any time. It is free, and there's tons of free information on it. Again, I want to say thank you to the Dallas group. The Dallas Options group is listening in today. They're logged in. I don't know how many folks they had come today, but from the post that was just a little bit earlier, it sounded like they had a good group this morning. So I want to kick this off, and I want to get started. Now, before I really get going, what I'm talking about here is obviously, hedging with stock options. But there is an awful lot of ways that you can hedge with an option. Like, okay, just because I do this way, I'm not trying to tell anyone that this is the only way to hedge with options. There's lots of things. But what I'm going to be focusing mostly on today is I'm going to be focusing on how you can hedge an entire account, your entire portfolio, what you can do and how you can protect yourself. And I thought it's kind of timely because the market's been a little bit, let's say choppy. Lots of whipping back and forth in a large trading range. Right now, the bulls seem to be back in control. But we've certainly seen some shock waves to the downside as well, and we should be prepared for that at any time. And having a good strategy to hedge your account is very pertinent in a market like this. So let's take a look. It kind of looked like everyone went long, didn't it? As if there doesn't seem to be any fear at all in the market. That's for sure. So let's go ahead and move along here. There we go. So when you think about stock options, they're most commonly thought of by people as just this high-risk method of stock speculation. As a matter of fact, options really tend to bleed over into this, into the realm of gambling on the market. If you have that gambling gene in you, you gravitate toward options because they give you that really high leverage, and it's kind of that lottery ticket. A lot of people think of it as that lottery ticket type trading. But the fact of the matter is, their intention, they were intended for something completely different. Now, if you look at the actual statistics of option traders, more than 90% of option traders lose money. And the reason is because they gravitate to that gambling type aspect. They don't have a good solid plan. They don't have a good process in how they trade them. I see this a lot. People will start off trading stocks and they lose money in stocks. They're losing and losing and losing. And then they find something about options, their accounts gotten smaller. They find out something about options and they think that options is going to be their savior. That options, hey, this is what I need to do because I can risk less money. What it actually does, if you don't have a good method of trading, it actually accelerates your losses. And that's one of the reasons, those gamblers and those folks that just don't know what's going on when it comes to having a good quality process in planning in your trading, they lose a lot of money in options. Well, in the 1970s, there was a couple mathematicians that won a Nobel Prize for creating the pricing model. It's called the Black-Scholes formula. And these two mathematicians worked on this. It's an incredibly complex formula. But the reason they got so much notoriety over it is because for the first time, institutions, big companies, were able to effectively hedge their risk and accurately hedge their risk. When you think about the big companies out there, the the Goldman Sachs, the Morgan Stanleys, the companies of that, just these massive companies with hundreds of millions, even into trillions of dollars that they have under their control. That is an awful lot of risk out there in the market that they really had no effective way of hedging. Well, options came around and the Black-Scholes formula came around and it gave them an effective way, an accurate way to hedge using options. So I look at options a little bit differently than a lot of people do. I don't look at them as that method for gambling or that high risk method. I look at them as a way of utilizing leverage in a intelligent way to actually reduce my risk to the market and potentially make more in profit and protect myself overall. So we'll move forward here. So when we talk about hedging, it's more of an art form than it really is a science, because everyone has, you put 10 traders in a room and have them look at a chart. They're all going to have 10 different opinions. Everyone's going to see that chart just a little bit differently. And, one of the things we talk about in the room and hit and run candlesticks and right way options, we get questions all the time. Should I trade this? Should I do this? Is this the right trade? And our answer back on that is, well, is it the right trade for you? You have to decide if that is the correct trade for you, the right trade for you in your trade planning. Okay? So everyone perceives the market a little bit differently, and they have a different tolerance to risk. And that's why I say hedging is a little bit more of an art than it is an exact science, because you have to make some assumptions to effectively hedge an account. So, but to get started here, to get a handle on how to use it, we first have to have a really good understanding of the Greek delta. Now, most traders, understand delta is a very important part, of options trading. Okay. Delta tells us, that the percent chance that an option will continue to be in the money by expiration. It also tells us how much an option price will accelerate or move up in value based on a $1 move of the stock. So delta is a really important number to know how to deal with when it comes to trading options. But there's another relationship that most people never think about and don't really know. In the creation of of an option, we have to go back and we have to understand what delta is. So if you have one share of stock, if and it doesn't matter what company it is, it could be one share of Apple, one share of Google, one share of Amazon, one share of SPY. Okay, doesn't matter. You have one delta. Okay, so every share of stock is equal to one delta. And so you can just, let me get a little tool here. So if you have 100 shares of anything, okay, 100 shares of anything, you're going to have 100 plus deltas. You're positive 100 deltas. Okay, so any stock position that you have has a delta value. If you own a stock, you have positive delta. Now, on the other side, if you're shorting a stock, you acquire one delta for every share that you're short. It's a negative delta value. Okay, so in a portfolio, if you had 500 long deltas and 500 short deltas, your portfolio is known as something called delta neutral. Now, if you look at market makers and things like that, you know, those evil guys in the background that we always talk about, you know, trying to damage us, their job, most of what they do is to remain delta neutral. When everyone is trading, they're trading against you. So let's say if everybody is piling into Amazon and they are creating, you know, they're making the market for Amazon, well, they're actually shorting Amazon at the same time. They're working to remain neutral in the market, always neutral in the market. And there's an entire method out there called delta neutral trading. You can look it up online. I can tell you honestly, I've never been able to make it work for me. In fact, it really is. The concept is if you're neutral, the market moves up, you take profits on the trades that are long. If you're neutral and the market moves down, you take profits on the trades that are moving down. The problem is you're losing on either side of that. You know, it's always back and forth. Back and forth. Truly delta neutral, you're even in the market. Okay, so I've never been able to make that work for me, but that works really well for those, you know, market makers and those bigger institutions. They can neutralize their risk to the market. So if you have that understanding of delta, it gives you an accurate way to be able to hedge. So let's say you own 100 shares of a company, just you own 100 shares of Apple. Okay. If you were to purchase, okay, one put option that has a delta of minus 50, you've actually reduced your risk on that trade by 50%. Because what you've done is neutralized half of your delta. Okay, so your overall risk is no longer 100 deltas to the stock, it's only 50 deltas. Okay, so you've laid off some of that risk. Is this, you guys understanding this? This gets a little bit deep in the weeds. I understand if you've never been a part of options, I understand that sometimes this can get a little bit deep. So please understand I will stick around and answer questions at the end. And if you have some, if I can catch them, I will answer them as we go along. But it's just important to know that one share of stock equals one delta. Okay. And that if you can determine what your delta value is, then you can effectively manage the risk of that trade by adding negative deltas. The same thing is true on a short trade. If you're short a position and you're worried about that short position, that you might get a really quick rally in the market, or in that stock, you can hedge that risk by adding positive deltas to that trade and laying off the risk. Okay. Now, we've been in this market here recently. We've seen really quick moves, right? I mean, like overnight, we get gap ups, gap downs that affect our portfolio. We get these really quick reversals. We don't get these nice smooth moves here recently. If it's going to move, it's going to move, and it just pow, it goes. And when that happens, we're damaged normally. If we're all long the market, if we're overly long the market, and we get a very quick shift, so many people just piled into the market this week. What if Monday morning we gap down 150 points? Well, all of those folks that were in the market, they're going to be thinking the sky is falling, right? Their accounts being torn apart. They're getting chopped to pieces. Well, they could have laid off some of that risk and minimized the damage. And I'll talk about how I did that here just a week ago and how I managed that trade so that I really had no stress in the market when it was sinking and bouncing around the way it was. Okay. So let's take this one step further and we're going to break it down. And geez, my lines here, I didn't notice that they were that crooked when I first put them on there. Apologize. So if you own 100 shares of stock, it equals 100 deltas. Now they break that 100 shares into calls and puts. Okay. So an at the money option, a true at the money option, if it's directly, if you have a $50 stock and you're looking at a $50 option, it's trading exactly at 50. The call option at the money should have 50 positive deltas. Okay. The put option should have 50 negative deltas. Now, some of you that have a little bit of experience might be looking at this and say, well, that's not exactly right, Doug. And you're correct. There's actually something out there. It's called the volatility smile or the volatility skew. If you look at a graph of the skew, it kind of gives you the impression of a smile. Okay, when you look at it, it turns up on both ends. It's lower in the middle. It's called the volatility skew. And if the market is highly volatile or something like that at the moment, what can happen is that skew will actually move over toward the put side just a little bit. So a directly at the money option may have like 48 deltas long and might be 52 deltas short. The skew may be moving that just a little bit. Okay. So it's called the volatility skew, and you can, it's kind of it's highly technical. Unless you really want to get into options, you don't have to worry about studying it much. Just know that as volatility increases, the skew kind of tends to favor the put side. Okay, the protection side, it kind of skews that direction. Okay, so think about those option contracts this way, that we have 100 shares and we've got a 100-share contract. Well, to break that up into two different parts, two equal parts, there's 50 positive deltas and 50 negative deltas in that portfolio. Okay? Hey, if someone could type in for Don how he can reboot the room so that he can hear, I would appreciate that. I see he's got no audio. Maybe Steve, if you can let him know how to do that. I have a tendency to want to tell him over the mic, and obviously he's not hearing that, so that's not going to help him out. So here's an option chain, and looking at an option chain, it's all pretty obvious what's going on here. But on this option chain, we have calls, okay, and we have puts. Now I'm looking at an option here, this 247 option right here. And it doesn't matter what symbol this is, okay? The 247 strike, you can see we had a net change of 35 cents, and we can see that this 247 strike option is in the money. It's shaded in. So that means the price of the stock itself is actually just slightly above 247. Okay, and you can see if you take a look right here, the delta, and I always have delta on my screen. Okay, delta is one of the most important things that I look at in determining what is the right trade. We're going to talk about the right trade here in just a little bit, but delta is one of the most important things to pay attention to when you're looking at any option trading strategy. You want to know what your deltas are. So in this situation, the 247 Octobers right here, this option is just slightly in the money. It has a 53 positive delta. Okay. If you go right over here, and you can see the put side delta is a negative 47 delta. Add those up, and what do we have? 100 deltas. We have 100 shares of stock. Okay, so by going into an option contract, you can see we're dividing our trade between the long side and the short side. That's what gives us the leverage. That's what gives us the ability to directionally trade effectively or to hedge a trade or an account. Okay, so always pay attention to your deltas here. Now, I also want to take a second here and right on this and point out something that's really important. Now, one of the biggest mistakes that people make, and it's one of the most important, it's a question I get all the time. In fact, I'm going to be doing a video about it soon, and I will be posting it to my YouTube channel. If you guys are interested, just look up Right Way Options on YouTube. And I have a bunch of videos there, a bunch of information, and it can help you kind of learn a little bit about options, okay? So right here is something really important to pay attention to. If you look at the at-the-money options, and this is a mistake that most people make in trading, they look right here and they say, well, the 247, that's $3.27. But if I were to, I could buy the 249, I could buy a lot more contracts. If I buy this option, this call option right here, it's only $2.09. And if you look at the open interest, you're going to find that that's where most people, look at this right here. Open interest is how many contracts are open. This is how many people make this mistake. The majority of people don't know what they're doing when it comes to trading options. Notice that the open interest, this is the highest open interest right in here. Now, let's think about what they're doing right here. First, if they buy an at-the-money option, let's take a notice of and understand just a little bit about these Greeks. They're buying a position with 53 deltas. So what does that 53 delta mean? That means for every dollar the stock moves, this goes from 247 to 248, they can expect their option to increase in value by 53 cents. Okay? But that delta also tells you that this contract here has just barely a 50-50 chance of staying in the money by expiration. So you've actually put yourself into a trade where the probability is about dead even, whether it will be a winner or a loser. Those folks trading down here, buying these options, first, they're trying to take a directional trade. Look at this, 52,000 or 57,000 contracts here at the 250. Okay? They're buying an option that has only a 36% chance of ever making it into the money. It can still move in value, but its probabilities are very low. 36% chance of being in the money. And it also says that for every dollar that the stock moves, if you think you're right in your technical analysis, think about this for a second. Think about this for a second. If you own this contract, would you rather have 36 cents for every dollar that the stock moves up? Or would you prefer to be up here in a trade where you can make 70 cents for every dollar that the stock moves up and have an option that has a 70% probability of finishing in the money at expiration rather than a 36% chance of finishing in the money at expiration? See, they're gambling here, and that's why about 90+% of the folks who trade options lose money. They're actually putting themselves into a losing situation right off the bat. Do you want a 70% probability trade or a 30% probability trade? You choose. Now, the other thing that they don't understand is the other Greeks. Now, the other Greeks, I'm not going to spend a lot of time on this, but I want you to look right here. The gamma tells us how quickly the delta will change in value. Okay? So at the money options or near the money options have the most sensitivity to delta. Notice that the gamma diminishes the further away, the further you go in the money, and it diminishes the further out of the money you go. Okay? So by buying the in right at the money option, you are putting yourself at risk for higher gamma. And that gamma is more sensitive to a price move. Okay? So just a $1 move down on this option puts you into a trade that has less than a 50% chance of finishing in the money. And also, it moves faster down it moves faster to the downside because your gamma is providing the acceleration to delta. Okay. Yes, that's right. Gamma risk is mentioning that gamma increases the closer and closer you get to expiration. That's another real big mistake a lot of people make in trading options is they don't allow for enough time. They don't allow for enough time for their trade. They want that cheaper one, okay? And they don't allow for enough time. The other thing, and I don't have it showing on here because I don't know why I made a mistake, and I've got open interest in 2 columns here, is theta. Now, theta would I normally have right here. Theta is also the largest and has the most impact on an option price at the money. Theta is the time decay, how much an option will decay on a daily basis as it moves towards expiration. Okay, so theta is stronger at the money. The further you go in the money, there's less impact to theta. Okay, so I'm going to give you a rule here in just a little bit on where you want to look for the right options for trading. And it's kind of the sweet spot for all of those Greeks, all of those things that you want to be focused on in your trading, okay? And gamma risk, yeah, you know, if you're very good at technical analysis, here's the problem. We all think we're good at technical analysis. How many of you would honestly say that you've looked at a chart and say, this is the perfect, man, this thing is gonna go up, and you buy that trade, you jump into that option, and then that stock lays there for 2 weeks and doesn't go anywhere? See, even great technical analysis, okay, you can be in a position that just doesn't move. So you don't want to be predictive of a price move. What you want to do, and this is a whole nother class, stop predicting, just follow the market. Stop predicting. Most people think they can predict the market. That is an ego trip that I can tell you will cost you your account and will keep you perpetually in what I call yo-yo trading. You get periods of good results because the market just happens to work really good for you, and periods of really bad results, and usually the really bad results wipe out all of the good results. Okay? And it will cause you lots of issues if you don't know what you're doing. So I've been trading for 27 years. I've supported my family, put 2 kids through college for the last a little over 12 years now, trading full time. Got a little experience at this. I'm telling you guys, if you play around, if you gamble with options, you're going to end up in trouble. You need to have this detail. You need to understand what you're doing. And if you get overly cocky with your technical analysis and think you're some kind of technical analysis genius, let me warn you right now, it's not going to work. Because we can't predict what's going to happen Monday morning. We can't predict what's going to happen, a news event that's coming out. North Korea, getting feisty and firing another missile. We can't predict those things in a chart. So even the best technical analysis, if you want to be accurate and consistently profitable in the trade, you need to adhere to some rules and stay consistent to your rules and protecting yourself in a trade. Okay? All right, so here's a problem. We're going to get into this, hedging this. So you're holding a portfolio. You're long the market, just like a lot of us are right now, or were, even a month ago. Everything was looking good. We had great signals in the market, lots of good trading, and you're long the market. But you look at the overall market and you see the potential here that it could start moving lower. You're starting to see signs of stress. You're starting to see, hanging man candle patterns and shooting star candle patterns and bearish engulfing patterns up at the top of a price action. And you start to have some concerns. Overall, you're holding about 7,000 positive deltas in your account. Okay, so what can you do? What should you do? Well, there's more than just one thing here to just hedging. First, number one, and by the way, yes, this is being recorded. So consider taking some profits to lower risk. Now, I always, this is one of my go-to things. I'm a big believer in taking profits consistently. Okay, I talk about it all the time in everything that I do. I sell positions as they're moving up. Okay, I don't get involved in the greed. If it's moving up, I have a nice profit. I'm selling it into strength. Okay, so consider taking some profits. If you're worried about the market rolling over, put some profits in your account. Don't let greed prevent you from making money. Okay? Step number 2 is make sure all your stop loss orders are properly placed, that you understand the risk, that you're protecting the gains that you've made, and you're protecting or willing to cut off losses quickly enough. Okay? So you want to make sure that you've adjusted all of your stops, that they're properly placed. I spend every morning, I'm at my computer at 5 a.m. every morning. Where I live, the market opens at 8:30. My morning is all about preparing for the day. Every single day, I go over every position I am in, okay? And I am always making sure that my options, my trades, my stocks, and everything are properly positioned for how I see the market. Okay? That's your first order of business, and that is the best protection that you can start with. But you think you're just loving the market, and you think that this could just be a little bit of a shaky point. You want to stay long your trades. They're all looking really good. You want to stay with them. So now we can think about doing a hedge. So if we were to take, that 7,000 positive deltas, and I always say a good place to start is somewhere around laying off the risk of somewhere around 20 to 25% of your account, of your overall risk. It's a good place to start because remember, we might take some profits out here, so that's going to lower some of our risk. We're going to have stop loss orders in place that if you're right and the market starts falling, it will start tripping those stop loss orders, getting you out, protecting your profits. So if you start with about a 20 or 25% hedge, that's usually a fairly comfortable place to be. So you just take your 7,000 deltas times 0.20, that's 1,400 negative deltas that you need to pick up. Okay, 1,400 negative deltas lays off 20% of your risk to the market. It puts you somewhat in balance with what you're seeing in the overall market. If you fear a market rollover, it helps you balance. It helps you sleep at night because you are hedged. Okay? You give up some of that risk. You're able to hold those positions, but you're managing your risk. All right. So now the next step is choosing the right security for the hedge. Now, the way I do this, and there's a lot of different opinions on this, this is the way I do it. You can do it any way you like. Okay. I usually look at the 4 major indexes, ETFs. Okay. I'm looking at the SPY, the DIA, the IWM, and the QQQ. All right. And if I'm looking at a market that could be failing, I'm going to look at those 4 major indexes and I'm going to decide which of those look the weakest. If the market's going to roll, which one's going to lead us down? So for example, in this last pullback, IWM was definitely leading us down. It had failed the 50-day moving average and was heading to the 200-day moving average in a real quick move. It was the weakest of the market. Okay, so we can all take a look at those and determine. You may find there's 1 or 2 that you want to focus on. They look the weakest, and that's where you want to think about picking up some puts to hedge your overall account. Okay, so whichever ones you perceive to be the weakest, that's where you want to be focusing on your puts, buying some puts in those weakest indexes. Okay, now keep in mind that a hedge, and this is a hard thing to do, that a hedge is different than just a standard trade. Our purpose of the hedge is not necessarily to make directional income or directional money. We're not about, it's not about the trade itself and trying to just make some money. It's there to protect us from a quick move to the downside. It's there to protect our overall account. So don't look at it as an individual trade. I see this happen all the time. People will put on a hedge and they're right in direction and it moves a little bit lower and they see a profit there, so they immediately take it. And then the next thing they know, they get up the next morning and the market's gapping down 200 points. And they've given up all of their protection because they forgot why they put that hedge on in the beginning, why it was there. It was a protection for your account, not necessarily a trade. And you only want to adjust a hedge After you've done a thorough look at those index charts, the market itself, and see a substantial change that, if you were thinking if it was bearish, and you all of a sudden see the bulls start stepping in and you're getting confirmation to the upside, that's when you adjust your hedge or consider taking it off. Not until then. Remember, it's a protection for your account. Okay? All right. Gary, yeah, I'm going to get to that here. Your question on that. So, picking the right options. Picking the right options. Okay. Annie, yes, this is being recorded, and what I will do is I'll get that recording to Rick, and we'll just post it on the website itself. So it'll be on the free side. Everyone will get a chance to, you can go there and watch it anytime. Okay. So picking the right option. If you're going to be in a trade, if you think the market is going to move south, or if you think the market is going to move north, bullish or bearish, you're making that decision. I always recommend, anytime I take a trade that has any directionality to it at all, I'm going to be looking at an option that's somewhere between about 70 and 80 deltas. Okay, so if I'm looking to hedge a long account against the market, I'm going to be buying puts that are somewhere between 70 and 80 deltas. Now, why 70 and 80 deltas? Well, first, we talked about this before. A 70 delta option has a 70% probability of being in the money. It's less sensitivity. It has less sensitivity to gamma. It has less sensitivity to theta. So I'm picking an option that has a high probability of being in the money. Okay. If the market moves against me, if I have that option that's in the money, I have more flexibility to adjust. And I have the ability to take that risk off before it costs me too much money. Okay, so it's a really good spot to be. Now, the 80 delta, why 80? Once you go past 80, you start having to pay up a little bit too much for your option. Your option prices start to grow a little bit too much, and you're giving up a little bit of your leverage. So if you look in this 70 to 80 delta range, you're going to find that as the sweet spot for most any directional trade. Okay, and you want to size your position based on that. Okay, so we're less sensitive to gamma, we're less sensitive to theta by being in that range. Okay, it gives you more time to adjust that trade because it's in the money. It's not going to move as quickly because that sensitivity to gamma creates better profits if you are correct on direction. You get a better return. We all want better returns, right? And then you have fewer contracts that you have to purchase. A mistake a lot of people will make is they're trying to hedge an account, but they're buying that low delta, so they buy up a whole bunch of contracts. You don't need to buy as many contracts if you're looking to hedge 1,400 in risk with 70 to 80 delta contracts. You don't have to buy as many. Okay. So, good question, VL, because that's exactly what I'm going to be answering right now. When you're looking at the market, when you're deciding whether you need a hedge on a trade, what normally happens if the market falls? It just gets busy and falls, right? There's usually not a long time period to determine whether it's going to go down or not. It just gets going. Okay, so normally when I'm picking up a hedge position, I am in a monthly contract and I try to have somewhere around 25 to 30 days. I can go a little bit less on it if I really think the market's going to move. But I can be in that, that front month option most of the time. Okay. I have never hedged an account with a weekly contract. First, the weekly contracts have, just because of their short-term nature, they have higher theta, higher gamma, and they're going to be, you're either right or wrong. It's just gambling. It's kind of like walking up to a roulette table and plunking down money on it, red or black. Either you're right or you're wrong. There's no flexibility. There's very little flexibility in a weekly option. So I'd never use those weeklies. I look for that little bit of time so that I can hedge or hold for that period of time that I think that that risk exists. Okay. Chicken's betting on black. Okay, so it allows more time to adjust and gives you that that better protection to the trade. So you want to look for that contract that is, in that 30 days. Now, it's okay if you have to buy a little bit more. If you've got to go up around 45 or 50 days or something like that to find that right option, that's okay. Remember, you're going to be buying a 70 to 80 delta option. Okay, so buying a 70 to 80 delta option inherently has less extrinsic value. Extrinsic value is what is affected by implied volatility. So you won't be paying as much for that just time by being in the money. If you buy it at the money or out of the money option, you're paying a higher portion of the contract cost is actually time value. And we know time is eroding every single day. Every single second, time is passing and it's eroding our position. So we want to be in a position that has less erosion over time. So being in that monthly, that where I have those, 2 or 3 weeks or more of protection. Now, if you see a market that looks like this thing is about to really correct, really go down, there's nothing wrong with looking out there a couple, 3 months for your hedge trade. Okay, if you think, hey, we're just set up here for a major fall, and let me give you an example of that. I tell this to everyone in my room. If you're looking at a stock chart, stock's been moving up, everything's been going along. That first move down that scares everybody to death, makes everybody think the world's falling. Everybody on CNBC is wringing their hands. All the drama comes out, right? That move is not the scary move. The scary move happens after we bounce back and rally, and we fail to make a new high, or we double top and have a failure pattern. That move right there is the scary move. That move is the one where you look at the overall market and say, holy moly, I need to protect myself. Okay. If you're an Elliott wave theorist, I'm not. But if you were to do a wave count on this, I know it. I just don't. I'm not a Elliott wave guy. Okay. That's wave 1. That's wave 2. The money waves, the biggest waves, are wave 3. There's wave 4. And wave 5. This wave here, wave 3, and wave 5 are the money moves. Okay? That's where the real selling starts. So it's not that first move to panic over. It's that failure on a rally back. That's where you want to be worried. That's where you want to really protect yourself in an overall market. If you start seeing that pattern show up, that's where you start taking profits, adjusting stops tighter, making sure you're protecting yourself in your trade. Okay, so let's say you're right. Okay, you're right, and the market does fall. Okay, you have stop losses. Your stop losses begin to trip. So you're collecting those, protecting those gains that you had in those trades, or you're stopping losses on those trades that didn't work, and they're starting to trip. Okay. Overall, your delta should be diminishing. So we started with 7,000 delta, right? But overall, if you're correct, if the market starts to fall, your delta in your account should be starting to diminish because those trades are coming off. Stop losses are tripping. You're taking profits, okay? There's likely going to be capital losses when that occurs, okay? You're losing money when that's going on. But let's think about it. If we have that negative delta position on our account, okay, that negative delta position is actually increasing. As a stock moves, remember, we've got a 70 to 80 delta position. If the stock moves sharply lower, our delta is increasing. Okay? Our delta is increasing. So that means that we're taking off some of our long risk, and our delta position here is actually improving in value. It's going up. It's going higher. So we're gaining delta. That means we're hedging more and more of our account. I will often start with a 20 or 25% hedge. And if I'm right on direction, within a couple of days, I'm hedging 50, 60, 70% of my account with my delta position, with my hedge. So more and more of my account is being covered as it moves in my direction if I'm correct. So I have more and more comfort in it. Now, in this last market turn down, everyone in Right Way Options heard me, saw me. I told them exactly where I was putting them on. I put on negative delta hedge for my account. When we had that big move down 7, 8, 10 days ago, whatever it was, that big move down, my long trades were losing money. My negative delta position was positive. In the day, my account stayed in the green. It stayed in the green because I was hedging that risk. My delta improved. My negative delta went up. It shot up. Boom. And I had protected more of my account. So I was staying positive in my account, even in that shakeup. My account never went negative. Okay? When the market flipped here this week and started moving back up, I started losing money on my delta position, on my negative delta hedge position, but my long trades were gaining value. So once again, I was staying green in my account through the entire shakeup. I had comfort. I didn't have to sweat. I didn't have to panic. I didn't have to make an emotional decision, sell something. And we've all done this, right? Market pulls back. We're in a great looking trade. Market pulls back. We get nervous. We sell the position. The next day, we look at it and the stock has moved way up. I didn't have to do that because I was protected. I could hold those trades that were moving up. And we took some great profits this week in Right Way Options as a result. We took over 70% gain in U.S. steel this week. I've got a huge gain in Berkshire Baby Berkshire. I've got a 55, almost 60% gain in TECK. Because I was able to hold those stocks during the pullback because I was hedged. Because I was comfortable. I could hold them. I was staying balanced in that shakeup. Okay, does that make sense? These are real trades, guys. This isn't fake stuff. This is a guy doing it over and over every day. I do this every day. Okay. I can't. Well, my charting platform TC2000, they're doing a major upgrade today. Their servers are down, so I can't even show a chart today because it's not available. But if you go on the website, there's plenty of examples of trades that we've made, great things that we've done. Lots of, you can ask anyone that's a Right Way option member. We do well in Right Way options. Okay. And most option folks, all they want to do is they want to hype up the great percentage gains. I don't do that. That's the last thing I want to focus on. It's not important that we made 76% on X. What's important is that we traded it right. Did we enter it correctly? Did we exit it correctly? Did we do the trade right? That's what's more important, not the gain. Did we trade it correctly? Okay. So if the market continues to fall, your hedge is growing, you've got more protection to the downside, you have comfort, you can rest easy because you are protected in your account. Yeah, don't close your put, and don't close your put until, remember, you're hedging your account. Don't think of it as a trade. Think of it as a hedge. It's there for the purpose of protecting the downside of your account. Okay? You're only going to take that trade off or adjust that trade, get out of that or cut it or reduce that, that hedge when you see the market confirm that direction has shifted. Okay? You should be able to take great profits. Okay? A couple, 3 weeks ago, I took and I told everyone in Right Way Options exactly what I was going to do before I did it and where I was going to do it if the pattern showed up. I bought Q puts and I bought diamond puts. And in that big move down that we had in one day, well, it actually moved down about 3 days. I took over 4,000 in profits on each one of those trades. Okay, so the market was falling. I was losing money on my long positions. Stop losses were triggering, all of those kind of things. But I made tremendous money in that little move down because I bought a hedge to my position. And everyone in the Right Way Options, or anyone here that's from Right Way Options that watched me do that, please confirm that to everyone in the room, that I told everyone exactly what I was going to do and where I would do it if it showed up. I hold nothing back in my trading. I share every trade I make with members, every single trade. Doesn't matter if it's a stock trade, an option trade. I share every trade I make with the members. Okay? So no games, I don't play the same kind of game that you may have seen in other places and other services that just want to market to you 5 trades a week. And think about that logically. If an option service is saying they're guaranteeing you 5 trades every Friday, you should run from that. You should run from that. Is the market good for trading every day? Is Friday a great day to enter trades every Friday? Absolutely not. No way is it good. See, they're not trading the trades. They're just putting out stuff and hopefully that you can follow. And we all get the emails, right? You get a laundry list. 8, 10, 12, 20 trades. Hey, we made 100% gain on these trades. What they never show you is the 50, 60, 70% of those trades that were losses. I don't play that game. I don't trade every day. I don't have to trade every day. What I have to do is be consistent in my trading. Consistently profitable is what I work for. Consistency is far more important than being right. If you want to stick around in this business, you have to learn to work for consistency. So, you're wrong and the market rises. Okay? You put that hedge on and the market just rejects the low and starts heading back. Okay? Stops moving back. So the long stock that you're holding continues to move higher. And let's keep in mind that you're going to likely have capital increases because remember, 80% of your account is still long. Okay, so you're going to have protection to the upside. Remember, you've set your stops. Everything is safe. All of those long trades are moving up like they should be. And so you're gaining money here and you're 80% long your account. Now, this delta position you're going to be losing money on. But think of it, it was insurance. We all buy insurance. Nobody wants to buy it, but we all buy insurance. We had a major hailstorm here the other day, and I just had my roof appraised, and they're totaling my roof. They say it's over. It's, you know, the hail took it out. Okay. Now, I've lived in this house for almost 13 years. I've never had that problem. I've paid insurance for 13 years. Okay. Never had to use it. I am really glad I have insurance today. Okay. So sometimes you just need to have a little insurance to protect yourself. And that insurance costs you. Okay. But remember, it's only 20% or 25% that's actually short. So you're not, and you can react and you can take that trade off. You're going to lose some money here, but that's what its purpose was for, is just to ensure a big downside move or something that you thought was imminently possible. It's that comfort. You bought insurance. Okay, so price action remains in control. Yeah, I mean, confirms that the bulls are going to remain in control. You just exit that negative delta position, just like canceling your insurance policy, and that risk has gone away, and your long trades are continuing to work. No, I don't let those hedge puts expire. If I'm right on direction and the market just keeps falling, you know, if we get into a major correction and I've only got a 30-day option, okay, what I will do is roll that trade. And what I mean by roll that trade is you're selling that put that you're in and moving out another month or two to continue to protect your downside on that market. So I will roll them. I will not let them expire. I use the Qs, QQQ, SPY, IWM, and DIA. Those are the four major indexes. That's where I'm doing my investigation every single morning of where I believe the market's going. And by the way, anyone, if you follow me on Facebook, on YouTube, on Twitter, I post a morning video every day to help prepare people for the market. It's my preparation. I just share it. Okay. So look up Right Way Options on any of those things and just click follow or subscribe, and you'll get that notification every morning when I put it out. And I put it out before the market opens every day, give you a full explanation of my look at the markets. Okay. So feel free to take advantage of it. There's no charge for that. It's free. Okay. It's free. Anyone can have it. Okay. So I'm just going to touch on this one in just one slide, and then we're essentially done. Individual stock insurance. Now, I use options to hedge individual trades from time to time. Okay, so say for example, Right Way Options was in a trade on Microsoft. And Microsoft, we were up substantially in that trade. The trade ended a little over a month ago, and my profit, because I traded 10 contracts, my profit in the Microsoft trade was about $8,500. Okay, so I was up substantially in the trade. Well, earnings, we sat through earnings on that trade. If I were really concerned about an earnings event or a news event or something that could take that trade down, the stock continues to look good and I want to stay in that trade, well, then I'm going to look for a way to buy insurance on that position. I've got substantial profits in it. Now my job is to protect them. So for example, here you're holding a nice gain in a stock. You have a nice profit in it, and you'd like to hold it through earnings. So how do you do that? Well, first thing you should do is you need to be planning ahead. You need to be looking out and finding out when that company is going to report. The best time to buy a protection hedge for an individual position is somewhere around 10 days to 2 weeks prior to that news event. And the reason is because we've all seen this, right? As we move toward that event, implied volatility goes up. Implied volatility rises. So if you wait until right the last day to do it, you're paying an awful lot in extrinsic value. You're paying for a huge time value because implied volatility only affects extrinsic value of an option. Okay? And what happens as soon as the event happens? Implied volatility collapses, it drops like a rock. And so that extrinsic value just collapses. They call it volatility crush. Okay? So if you can get in there, if you plan ahead, if you can get in there before that implied volatility really starts to crank up, first you get a cheaper option. You're not paying up as much for the option. And you can lock in a value. Let's say you are in a stock and you bought it at $30. Okay. It's now at $50. And you look, and when I'm going to hedge around an event like this, I'm only looking to buy enough time to really get me through that event. So I will normally be in a monthly option because at first I just don't like weeklies very much. I'll normally be in a monthly option. And I will be just looking into that front month. I want to have a few days left on that option by the time the trade has happened. I want to have enough time to be able to adjust. If you've only got 2 weeks left in an option and the event is coming in 2 weeks, that's not the trade to take. Take something that has about 30 days plus in time so that you can wait that period. You're not getting a big effect on your trade. Okay? And then I buy the option at the price that I want to lock in my profit. So for example, the stock is at $50, and if I want to lock in the $50 stock or $50 price tag, I buy a 50 put. Okay, and because I'm buying a shorter term option, the prices aren't expensive. It's like buying insurance, but it locks in. By buying a $50 put, it guarantees me $50 a share for that stock. Now, if you're willing to accept a little bit less, you've got a nice profit in, you could buy the 45, pay a lot less for it, but lock in $45. You're guaranteed $45. Linda, if it doesn't have options and I'm in a profitable position and I'm heading into earnings, I am exiting that trade. I will not stay. If I can't protect myself, because a stop loss won't protect you, will it? You put in a stop loss order, the stock can gap right past you. It won't protect you. So I exit the trade. I'm just out. I avoid the risk of earnings on a trade. Okay? Chris, I would avoid the out of the money triple leverage products. And here's why. Just go take a look at like the implied volatility of TZA. The implied volatility of TZA is probably going to be somewhere around 75, 80, 100% implied volatility. That means you're paying an awful lot in extrinsic value or time value. That triple leverage product is always going to be much more in implied volatility. One of the reasons you trade options is for cash efficiency. Okay. Again, when people are they're trying to engineer the system. Well, if I buy a triple, then I'm just going to make all kinds of money. You're thinking of this as a trade. You're not thinking of this as a hedge. Remember, we're trying to protect the downside of our market. We think of it as a hedge. We want true protection. Don't go with a leveraged product because you're not even sure how that leveraged product is leveraged. Remember, an inverse ETF that's 3 times short is constantly buying and selling options to get that leverage. So they always have options expiring. You don't know exactly what you have there. It may not be the best protection. And you're going to spend a whole lot less buying the unleveraged product in time value, your extrinsic value. It's more efficient in your cash. Okay? Much more efficient in your cash. So just take a look at your implied volatility. If you need some help on that, take a look at we talk about this stuff all the time in RWO, right way options. You can ask any of the members. I don't hold anything back. I don't care if it's a stock question, option question, I don't care. I will do my very best to explain that so that you can be on the right side of the trade, okay? In the best position that you can possibly be for your current perception of the market, okay? For protecting yourself. All right. A book on IV, implied volatility. No, but I can tell you that I've done several classes on applied volatility. They're available on the website for members. You can take a trial and watch the implied volatility classes. I couldn't, right off the top of my head, think of a good book for implied volatility. Okay. So, everyone stick around. You're going to want to hold on here. I'm finishing up. So first, here, real quick, right way options, hit run candlesticks. This is what we're about. Hit run candlesticks is a live moderated trading room all day long. It's generally open about 24/7, but it's really only active during market hours. Rick puts out, and you see Rick's picture up there, he puts out one fully planned trade every day. And when I say fully planned, it's fully planned. Entry, exit, targets, the whole works. He puts that out every single day. Sometimes, I should say, sometimes he does it on Friday. Or if the market's really funky, there might not be. But mostly every day there's a trade idea. He also puts out 10 to 15 other ideas every day. Okay? And then you have access to us all the time. In the live room, Rick is moderating the room most of the time. But 1973 Hog, and we have a great trader by the name of Ed Carter, myself. We're always in there answering questions, looking at charts, helping folks with their trading. That's going on all day long, every single market day. Okay? We really share everything, actual trading. This isn't fake stuff. When Rick buys something, he tells people he bought it. When he sells something, he tells people he bought it. Win, lose, or draw, he tells them what's going on, okay? Right way options, I do 2 hours of education every single day in the right way options room. It's from 11 a.m. Eastern to 1 p.m. Eastern every day. We actually put on trades live during that time. I send out trade ideas in emails and stuff as a trade alert, so that members can not only learn to trade, but use actual trades as part of that learning. Okay, as part of that learning in the trade. It's about being a quality trader. Okay, and again, I share everything that I do as far as trades go. You get a daily market preparation video sent to you every day. I don't hold anything back ever. And I do these e-learning classes twice a month that are recorded, and they're all archived and stored on the website. So if you guys have any interest at all, real soft sell here, click that button right there. Click that button and you can go get a trial. Now, we used to do a free 30-day trial. The problem is we had people, it's the way of the world nowadays. People were scamming us, changing one letter in their name and getting another Google address and just getting 30-day free memberships forever. And so we had to end that. So we have a $14 charge. But you get all of that. It's $14 for hit and run candlesticks, $14 for right way options. I don't know where you're going to get a deal like that. I don't know of any option service that puts as much time into education that we do. Any of them. I don't know any of them that's as open to exactly what I've done every day. I don't know any of them that are like that. And what Rick does during the day, what we do in the hit run candlesticks room is nothing short of remarkable, because we're working all day, professional traders, helping others make money. Learning and earning at the same time. I think it's the best deal on the internet, and check it out. Okay, so now I promised everyone a free ebook, and there is your download link for the free ebook. Let me talk about this ebook here for just a second. Okay. In this, it's more than just an ebook. It's only about a 14-page ebook. Okay, it's nothing fancy here. But what I do in this ebook is I share a strategy that I use to make consistent profits. And I'm telling you, it works. Okay? It works over and over and over, and it really has helped people from all over the world. I do coaching with folks all over the world, and on their trading, helping them in doing something simple like this. Now, I am unapologetically a very conservative trader. And I use very simple charts. It's not hard to understand what I do, but it does take practice, and it does take a commitment. Okay, just like anything worth having takes practice and commitment. But in that ebook, you're going to have a link. There's a link. I use TC2000. So I give you the scan code for this trending scan that I use. And you can feel free to reverse engineer, it's nothing fancy either. You can reverse engineer that for any platform. But there's a link to that in the book, how to get that, so you can build a qualified list of stocks. So you get a full explanation on how I build a qualified list so I can be efficient in my work. Okay. You're also going to get a PDF that tells you how to put this one indicator in your Thinkorswim. If you have Thinkorswim, we had one of our members write this code and converted this indicator to Thinkorswim script. You get a PDF on how to put that script in, and it works. It's fantastic. So you get that free as well. You also are going to get a PDF on building that qualified list scan. Okay. So not only the criteria, but how to build the scan. So 3 PDFs in that book. And then also in that book is a link to a series of videos on this strategy. Okay. Right now there's 5, and I'm adding to it. Okay. There's 5 20-minute videos already, and I'm adding to it. No cost. You can learn how to use this strategy from these videos. So you get the ebook, the videos, and all the information to put it together. I'm not holding anything back here. Okay. Not going to find a better deal out there. So, with that, I am going to say thank you to everyone. Now I'm going to stop the recording here, but I'll stick around for questions. I want to say thank you to everyone for coming today. I want to say thank you very much for participating. I hope you got something out of this. Okay. AJ, yes, we can get you a promotion if anybody is looking for a full membership. Do me a favor and just send me an email. And we can get you an offer for a full membership. We give you, we do a great deal for an annual membership. So I want to say thank you to everyone. I'm going to go ahead and stop the recording, and I will stick around for some questions.